Good evening, everyone. My focus for the day is on digital securities and their ability to transform capital markets. Before I proceed and get into the nuances, I want to make sure all of us are on the same page when it comes to certain definitions or the building blocks of this ecosystem. So a key term that will be used across this presentation is blockchain. Blockchain as a technology has the ability to disintermediate trust. What does this mean? So for us as finance professionals and investment professionals, we rely on multiple intermediaries who are prevalent in a transaction's life cycle to provide that transaction authenticity, or that's where we derive trust from, the fact that there are multiple third parties related or participants within a transaction's life cycle. Within a distributed ledger technology, or blockchain as it's more popularly known as, because multiple ledgers are held across multiple places, and when one transaction is not entered across all those ledgers the same way, the transaction fails. You are unable to execute on that transaction because the transaction was not recorded the same way across all the ledgers which are held across multiple places. And that's how a distributed ledger technology disintermediates trust. This simple facet of what it is, a cryptographically encoded database, this simple facet of this database is what makes it unique. It's what gives it its transformative ability. And my focus today would be to see how this facet of this technology can come into the capital markets in the form of an evolution that happens on a financial instrument, that is any form of security, and how that would impact all of us, or the capital markets in general. Another thing that I want to clear the air on is the common thing. The moment you mention blockchain, it's immediately linked with cryptocurrencies or Bitcoin or ICOs. I'm not here to talk about any one of them. Cryptocurrencies exist on a blockchain, and if not for Bitcoin being issued on a blockchain, the whole technology probably wouldn't have taken, the last 10 years probably would have been 20 years, if not for all the hype that was there. For all the scams that happened within the ICO space, for the multiple ways in which they issued securities and broke securities regulations across various jurisdictions, there was one thing that I think we should take away from what the ICO boom did. That is, they showed us for first time is that here you are presented with a technology, and you have a bunch of guys, guys, girls, the full world, getting together, utilizing that technology and raising capital from across the world. That's what they did. They took the technology and they broke down barriers when it comes to raising capital, and raising capital not from accredited investors, not from professional investors, not from institutional investors, but from mom and pop, right? Your retail base. And they brought in nearly 50 million unique investors in that period, raising close to $8 billion in US dollars in capital within a period of 3.5 years, using unregistered illegal offering of securities, right? So we're not going to focus on that, but we're going to take one facet from that, that is, whereby the world for the first time saw that crowdfunding on steroids can be done when tech is introduced. Accessibility to a global pool of investors can be enabled when tech is used properly, or when the key facets of the distributed ledger technology are used. So these are the key nuances of this technology that I would take on moving forward to build the story around digital securities, or what my focus is within that for the day today. What are digital securities? Well, just like any other financial instrument that we use. It's a negotiable financial instrument issued, traded, owned with proof of ownership, recorded on a distributed ledger. So what is a digital security? It's a negotiable financial instrument with proof of ownership recorded on a distributed ledger or blockchain. You might wonder, aren't securities already digital? Aren't you able to take on a phone, log into your broker's app, buy a share? You can do that online on your desktop. So what's the big deal? Yes, securities to some extent are digital at the moment. So partially yes or partially no. But they're not entirely digital. So this is why you might see when you read things, they might say there was an electronic transfer of shares, right? Until the proof of ownership is transferred, even in a stock exchange, when a trade happens, right? Until the trade cycle is completed, they would refer to the transfer as an electronic transfer of shares, right? The reason is because, unlike in a digital security, where the proof of ownership is recorded on the ledger, and when transfer happens, both the transfer of security and proof of ownership happens at the same time. In the conventional world, even within an exchange, the entire life cycle is not completed. So securities at the moment, yes, are digital, but the entire life cycle of a trade's life cycle is not entirely digitized. And on the lighter vein, it's like some of the banks talking about digital banking, right? So you hear a lot of buzz these days about digital banks, or a conventional bank launching another digital bank. It's something like that, where it's not truly digital banking. Because if banking were to be truly digital, the entire process has to be digital. That is including the back office and the mid office, not just the client interface and the client onboardings. It's something like that. That's what we have even within the security space at the moment. It's not entirely digital. Is it happening? Yes. Let's see how. So what are the missing pieces of the puzzle to have, from a purist point of view, a true digital security? One is the proof of ownership, where the proof of ownership records are maintained, and the other is how the trade settlement or transfer of ownership happens. These two key facets, right? Those are the two missing pieces. Have we found the missing pieces? Yes. A few weeks ago, the company was Overfuture, got themselves approved to have their articles of association, or the company incorporation and the registry, the corporate documents were approved to have their shareholder register on a blockchain, recorded on a distributed ledger. Which means, unlike a normal company now, okay, now let's look at a company in the private space. Where is the shareholders' records maintained? It's either maintained in the company's registry or the company's house or the equivalent of that. Okay? What this changes, okay, and this is a key piece to the puzzle in terms of the transformation that we're going to talk about, is that for once, there was approval given for the shareholder registry to be maintained on a blockchain or a distributed ledger, which means In a court of law, if one were to go and say, I am the shareholder of X LLC, you would take the documents from the company's, the company's registrar, the company's house, the equivalent. Okay? In this case, what's valid here is the fact that your records need to be on that chain. So you need to be able to verify that hash and show the shares, link yourself to that hash. That's the only way you verify in a court of law that you are the rightful owner of this entity. Okay? The fact that you can now take a record on a digital, on a distributed ledger and show it and present it in a court of law as proof of your ownership is transformative. It's what enables you to remove the back end, the paperwork, the notaries, the lawyers who would certify different things before you have to transfer. All of that is gone because now you can take it on a chain. Number one. Number two, again, I'm using a Swiss example because I like to connect it to, but this has been even done in other jurisdictions. Okay, so you see the parties involved. So the only new guys I need to probably point out here is Swisscom. So that's the telco coming into the game here. But other than that, everybody else is a financial services provider. What they did, in simple terms, they took a company, its shares were digitized, i.e. issued on a distributed ledger, and they did a transfer of securities, buyer to seller or seller to buyer, and settled the transaction whereby Deutsche Börse took Swiss francs, converted it to stable coins, i.e. Issued a token backing 1 Swiss franc temporarily, which for the purpose of that transaction, and settle the transaction real time, DVP, delivery versus payment. Okay, so shares were transferred from a buyer to the seller, same time the proceeds or the equivalent of transfer of proceed in the form of transfer of Swiss francs from the buyer to the seller was done. Okay, so these are key things in terms of the evolution that's happening now, because what you're looking at is how would you settle when you trade on an exchange? Of course, your broker would immediately deduct your balance from your brokerage account every time you buy a share, and your brokerage account would be updated with the cash balance pending settlement, whether it's T+2 or whatever. But it doesn't happen real time. It's T+2. Of course, Saudi is T+0, but most markets are T+2. So which means transaction day plus 2 days before the cycle is completed. Okay, and none of this happens real time. This is how you do it real time. Okay, so if a digital security, and that's for the purist amongst us, okay, if a digital security in its purest form were to exist, the court of law should recognize that the securities registry is valid when the transfers are recorded on a ledger, and two, it needs to be able to settle instantaneously. Now that is a pure digital security. So that's why I want to link this up to, as we are talking about capital markets transformations and all the little things that are happening here, there is also quite a bit of transformation happening within the payment space, or money as we know it. Right? One aspect is where what you call a central bank issued digital currency. My desk research tells me there are 80 plus central banks doing various levels of research on this and to be issued. I don't know if it's true, but what I know for a fact in terms of being able to verify, There are at least about 12 central banks who are actively advanced in terms of their capabilities to issue a digital currency. The press seems to believe that it's China who is most advanced in terms of being able to issue a digital currency when they have to, or when they want to. And again, from a definition point of view, I've kind of split it, because I know you might ask me, hey, how does PayPal transfer money? Doesn't run on a blockchain at the bottom. Okay, so for a currency to be truly digital, there are many ways. Again, they call it electronic cash, right? But within the available technologies now, if a central bank is to issue its fiat currency, be it a dirham, a dinar, a rial, equivalent on a chain, the best technology that's available now is to use the blockchain and issue it, because of its immutability aspects, and you can't do double spending. Now that takes a while for a country to get its act together and release. So the private sector works on this, the second level, which are stable coins. Easier, can do, immediate. You and I can try and get it done too. What are stable coins is cryptographic tokens, right? So in a blockchain, every time a block is updated and the record is transferred out, a token is there which links one to the other and moves on. So each of these tokens, when they are backed by a fiat currency, so for example, 1 unit of token represents 1 dirham, or 1 rial, or 1 dinar, that's a stable coin. It's just, it represents something. You keep the money here, but on this ecosystem, you operate the tokens. That's a stable coin. Why did I bring this here? Because for a pure digital security to exist and settle, right, you need a corresponding currency which is also in that form. Right? It could be a central bank issued digital currency, or it could be a stable coin, but whatever it is, that's when you can do DVP, delivery versus payment. And there are quite a bit of transformations happening in this space. It's not for discussion today, but it's something that might be interesting for you to look at as well. So what are the key benefits of digital securities? I believe the key impact, or the most transformative impact digital securities will have, is within the private securities marketplace. What is the private securities marketplace? It is the companies which are not listed. It is the marketplace where securities which are not tradable or listed on an exchange exist within. So any financial instrument that is not available on an exchange exists within a private marketplace. Digital securities can have the most profound impact within this space. Why? Because their inherent abilities to be able to be transferable, to be able to have verifiable proof of ownership, to be able to do a transfer swiftly, is what? These are key ways in which they would improve efficiency. And these are the key inefficiencies within the private marketplace. How long would it take for you to take an LLC share and transfer between 2 individuals? Multiple people, you need a lot of paperwork, you need to run up and down between companies' house. Takes time. Digital securities can change that. A lot of bonds, corporate papers, notes are issued in the private marketplace. It's not easy to trade them. It's not easy even to custody them, right? If they were to be digitized and issued as digital securities, that would have a transformative impact. Let's not even go so far. Maybe it's your favorite restaurant. You go there every day. You like this. You would put your money in it because, hey, you want them to be around. How easy it is for you to invest into this company. It's not so easy. I mean, you can speak to the owner and take a share, but then that's it. After that, your money is kind of buried in it. It's a private company's enterprise. More than that, say if someone in one part of the world where, say, maybe biotech is not so popular, or has a startup which is in an industry for which organically there aren't many investors within that geography for them to source from. Digital securities enable these people to look at markets where there could be target investors, because now, because of the inherent ability of having issued their share as a digital security, they would be able to reach a wider pool of investors. So these are ways in which digital securities, when issued right, can transform private marketplaces. And I believe, if done right, from a secondary market trading point of view, they could blur the lines between what it means to be listed and unlisted, where the only thing that means to be listed would be you have satisfied a particular exchange's criteria and you're within that walled garden. But in terms of secondary market tradability, secondary market price discovery, when done right, you would have been able to break a lot of those barriers. So it improves efficiency within the private securities marketplace, improves liquidity price discovery, disintermediates access to global investors. And I can tell you from my personal experience, I'm handling clients out of Japan who takes old properties within premium areas of Tokyo and redevelops them and sells it out. Okay, and builds apartments, runs a traditional Japanese inn, and so forth. They are into an expansion strategy of building hotels and so forth within Tokyo, and these days the Japanese real estate market is doing relatively well compared to their neighbors because of Olympics, right? To seize upon this entity is issuing their companies, is raising capital via the issuance of their securities to global pool of investors. But look at what's happening here. They are a known brand within Japan, and more importantly within some areas of Japan. But now they are able to bring their story to a global pool of investors and then make those investors be able to access their shares. I'm dealing, again, from personal experience point of view. Key producer of agave syrup, a sugar substitute, okay, and also can be used to produce tequila. Wants to have a global expansion plan, private company, raising debt from a global pool of investors via digital securities. These are not startups. These are companies which have existed for 20 years, have a top line of $100 million, bottom line of a couple of $1 million when it comes to the Japanese entity, 300 million top line, 25 close to bottom line for the agave syrup producers. These are not startups. They could go to a bank, but they choose not to. Instead, they want to access the capital markets. But because now they can access those capital markets via issuance of digital securities, they don't have to deal with the traditional people associated with that part of the capital markets. They don't have to go to a stuffy commercial bank and negotiate a corporate loan, or an expensive investment bank and negotiate a transaction. Instead, they structure it to reach a wider pool of investors who are interested in their products. Yeah.
I was just curious to know how an ecosystem is built around the whole concept of reaching out to the prospective investors. Because if you see in the traditional world, there are custodians who are regulated by, financial services regulators to make sure that, they don't go away with, money of the clients and stuff like that. How they safeguard, client assets. So in this kind of a world, how those aspects or how the ecosystem is built to make sure that, no frauds happen or, clients get what they're promised and stuff like that.
So the answer is pretty straightforward, I believe, because nothing's different. We're not doing anything different here. This is an evolution. You remember the days when people used to trade shares by screaming, the pit trading? Yeah, and then it became electronic trading, and now we trade on the phone. Or the time, maybe it was early 2000, I still remember, when you had to use your credit card to buy stuff, and people were scared to use the credit card because there were frauds related to cards being smacked. I'm talking late 1999, early 2000, yeah? But it's the same. Like, there's nothing new being done. It's just that there is a transformative technology which is evolutionizing the process, and through that means it's bringing on certain efficiencies. To answer more specifically to your questions in terms of role of custodians, how is fraud prevented and stuff. So if a company is going to be listed, then we'll keep that out, because they're not going to come now and get themselves digitized. Of course, the exchanges within which they are trading at the back end are looking at settling on a chain, and I will go through those examples down the line. But to answer your question now, with your thing is more concentrated within the private securities marketplace. So, are there custodians for digital securities? Yes. Are they licensed and regulated? Yes. Who are these people? You can go and check. There's BitGo, Kingdom Trust, Prime Trust, Fidelity, Backed, which is backed by New York Stock Exchange. Some of them, someone big. I don't remember who backed. Yeah, Backed is big. They're backed by key players. ICE, yeah, there you go. So you can go back and see whether there is institutional ecosystem to have custody, yes. But see, that's the thing here. When you have your security issued on a distributed ledger, okay, you don't need a custodian, right? Because that is the key facet of this technology. It's recorded into an immutable ledger. And because there are multiple people recording their transactions, that's what brings the authenticity. If all those records aren't recorded the same way, the transaction would have failed. So to have a distributed ledger and then also expect to have custody on that, it's relevant for an institution. Because for an institution, you'll have the fund manager or the investment manager handling the transaction. So you need some form of segregation of power there, right? From that point of view, yes, a custodian is relevant, right? But from a technology point of view, it eliminates that need. That's the key facet of the technology. It disintermediates trust. It brings trust. You can do. You don't need trust to operate in this ecosystem, right? That's one. The other question, other part of your question is, okay, you put in money into an entity. How do you make sure that that was not a fraud? How would you do that in a normal transaction? Same way to what you have to do. Nothing else has changed there. Just because a company goes and digitizes and issues its shares or its bonds as a digital security, it does not make the entity any better or worse. It just made it easier for you to access its shares. You can own and buy, sell, transfer its shares, its bonds faster, cheaper, quicker, more transparency, so forth. It doesn't change what the entity is. It doesn't make it any better or any worse. It just made it more accessible for investors. That's it.
So what you're here talking about is the transaction completion, really, rather than the transfer of information between parties before a transaction takes place.
Yeah, pretty much. It's on that side of the trade cycle where the maximum impact is from a trade settlement point of view. But on the other hand, it also deals with how much you can access, because say for example, we are sitting here in Dubai, right? And let's say I tell you about a very interesting company which has phenomenal track records and so forth, audited accounts, you name it. It's a crown jewel within an industry, but it's in a geography that is unknown to you. Okay, now if I were to tell you that there is an investment opportunity here, and for whatever reason, I mean, from a suitability criteria, you do qualify to invest there, you would still be a bit reluctant, right? Because it's in an unknown geography. You need to figure out how to access, how to buy shares there, how do I sell it, how do I transfer it, all of those things. Yeah, if it was in the digital security, you don't have to worry about that part of it. That's it. It doesn't make this entity any better or worse. It just solves that little nuance related to that inconvenience you may have had previously, if not for this.
Cryptocurrencies or the digital securities, are they recognized in UAE? Have they been regulated already? This digital securities, or you can see the Bitcoin, this kind of currencies.
Okay, so that's the first thing I did before I started, is I wanted to clear the air. These are different animals. The nature of the beast when it comes to a cryptocurrency and a digital security are two different things. Okay, cryptocurrencies are, that's what they are, currencies. They are issued on a blockchain. They're not regulated by a monetary authority of a country or a region. Instead, they are cryptographic tokens which are verified by multiple distributed nodes, be it proof of work, proof of stake, algorithmic processing, whichever way they process the transactions, and thus they are utilized as a medium to transfer value. Okay, that's cryptocurrencies. Digital securities, on the other hand, are negotiable financial instruments issued on a blockchain. They are your conventional shares, bonds, units of a fund, LP interest, ETFs, share of profits of an entity, any financial instrument you can think of, digitized and issued on a ledger. Apples and oranges. The only common denominator there is, the base layer is a distributed ledger which validates each transaction and proof of ownership. Other than that, two different things. Tomorrow you want to transfer, you want to put something of value on a chain and make it tradable, you can. Right? It doesn't have to be a currency, it doesn't have to be a security, it could be something else. It could be loyalty points. Loyalty points on a blockchain technology being used here and now in our daily life. So that's you want to trade that, that's a utility coin then.
Just to, like you give the example of a Japanese company trying to raise funds, so still the local foreign control regulation will still apply?
Yes, yeah, absolutely. Actually, that's a key benefit that I will be talking down the line, but let me address it now. When you are looking at global transfer of securities, okay, so and especially within the private securities marketplace. So let's look at an investor, and I'm going to use a US example here simply because the private securities markets definitions are easier for me to explain. But each country has its own nuances, and we can get into it, but I'll use US as a base case here. So in the US, if you are going to issue a security for private as a private security, you can do it under Reg D, Regulation D, which is a safe harbor regulation, which means you have exemption. You can do it as Reg D 506B, which means up to 35 retail investors, and the rest up to total up to 99. The rest have to be accredited investors, which means individual means more than 200,000 in income, spouse means 300,000, otherwise net income excluding primary home of residence should be a particular threshold, maybe $1 million or something like that. I don't know the numbers. The compliance people here probably can guide us on that. So that's, you can access 99 investors under Reg D. Same time, for the non-US investors, you can issue the same share under Reg S. Okay. Now, once you issue a security under one of those regulations, when it's going to get transferred, say a Japanese investor is going to buy, you can only have 49 Japanese investors participating in a private placement, and they have to satisfy certain standards, like they need to be qualified investors. If it's in Australia, they need to be wholesale investors. If it's in Europe, provided it's not a fund and it's a direct equity that you are participating, minimum, they need to be professional investors, and each investor has, like say for example, I think in Luxembourg is 125,000 euro and above, Czech is 50,000, France is like 100,000 something. Different criteria, minimum value. So each country has a different criteria when it comes to private securities and how they transfer. In the UAE, I think that it's a bit gray, but with my limited interpretation, understanding of the rules and interpretation is that it needs to be reverse solicitation. So they don't define the investor criteria, but it needs to be reverse. So I cannot come and sell the security to you. You need to come and ask me that tell me that you are interested, and then I can sell it. Saudi, it's, okay, please tell me.
There is a regulation for the qualified investors.
Professional investors within DFSA.
Have like a wealth of 5 billion and have income 1 million.
So that's the criteria if I want to go and reach out. And if you don't qualify that, but if you expressed interest, then that criteria falls through. It's not relevant, right? I can, if in a reverse solicitation, does that criteria still matter? Even in a reverse solicitation?
Doesn't matter. You're right.
No, I understand from a marketing point of view. Okay, but maybe from a suitability angle, maybe you have a point. I still have to give into that. But anyway, I'm not a compliance guy. Huh? I like to buy, sell, and this is for someone else to think of it. So, but you know, broadly speaking, those are the criteria you need to follow in a private securities. In a digital security, what makes it cool and unique is that you can program that in the security. You can program all these rules within a security. That's how you can reduce your compliance burden, which means if a Reg D investor who is subjected to 12 months lockup in a private security wants to sell out to another US investor, if you transfer the security, the transaction won't go through because the code inside, or they call it the smart contract, would prevent the trade from happening. And if you already have 49 Japanese investors, and if there's a 50th Japanese investor who has come in and who tries to buy, and you try to make a trade, the trade won't go through because the code will prevent you.
sorry, my understanding, like all securities now are electronically traded, yeah, through the exchanges. So what's the difference between the electronic trading and digital securities? And will digital securities be traded on exchanges?
So the first part of your question, securities now in an exchange are traded, yeah, electronically. I think the most common protocol is called the FIX protocol that's been used to settle the trades. What's the difference between a digital security and something that's traded in an exchange? Exchange is a walled garden. Digital security can be traded peer-to-peer, can be traded via an exchange, can be traded via a marketplace, anything. It's just that now you have your proof of ownership on a ledger which is publicly available to see, can queryable if it's a public chain, then you can do the transaction in a place of your choosing. Are there digital securities exchanges? Yes. Open Finance in the US is a licensed regulated digital securities exchange. 1X in Singapore is a licensed regulated private securities market exchange within which Singapore Stock Exchange has invested in. Monetary Authority of Singapore has approved this. iStocks was approved a couple of weeks ago out of Singapore. You have NX. NX Exchange is a digital securities exchange as well, but little bit different. But yeah, you can do peer-to-peer inside that, but it's more of a walled garden setup. Yeah, there's multiple exchanges coming up as well. The Swiss Exchange 6, Swiss Digital Exchange, they are building the Swiss are building an exchange only for digital securities. What you will see in the future is probably exchanges settling on a chain, even your main exchanges, because it eliminates systemic risk. Next one, improve settlement speed for all the obvious reasons that we spoke about. That is in terms of its ability to be programmed, DVP, and yeah, you don't have to do the whole thing that we do in a conventional thing. That is, it goes from front office, middle office, back office, goes to the bank, the couple of slips gets exchanged and all the rest of it. The sequential process that they do, that's not there. So that's where the speed comes in. Yeah, key in compliance. A lot of features that you have in today's world of securities trading and monitoring when it comes to compliance, all those multiple verifications and the things we love to see as traders. Yeah, a lot of it can be taken out in terms of eased out, in terms of verification, ability to program it inside the security, use smart contracts, from investor onboarding to each trade settlement, how people place orders on an exchange. Like, for example, NASDAQ's surveillance. So every exchange needs a surveillance system. That is, they need to check if there are spoofing, or if you are putting what I mean is, some people want to create artificial interest in a market. So you put a bid, then you remove. You keep putting bids. You keep putting a lot of orders on the buy side, so that when I look at the bid and offer, I see, oh, there's a lot of demand, but this is fake, right? So these are practices you can do in an exchange. So NASDAQ has a surveillance system which is renowned for its capabilities. Gemini uses NASDAQ's surveillance system, which is used for your normal securities markets, to monitor cryptocurrency trades on its exchange. Okay, what does that say? What does that say about Gemini, and what does it say about NASDAQ's intentions? NASDAQ is giving their surveillance system to a cryptocurrency exchange. So this cryptocurrency exchange is using these surveillance systems to get their license to be SEC licensed cryptocurrency exchange. Okay. and to tick a bar of surveillance, bang, they've got the best surveillance system in town. On the other hand, for NASDAQ, what it means is, here I am giving my surveillance system to you. You are operating cryptocurrency trades, which means it happens, you can do it really fast. It's boom. It's a trade happens, peer to peer. It's on the exchange or whichever way, but it's happening on the chain. And I am having my system tested in a live environment. So tomorrow, if you want to trade shares, my system has been tested on a similar environment where trades were happening, right? What does it say about NASDAQ's view of the future? It means they are preparing for an eventuality where their exchange would also be trading digital securities. Maybe partially, maybe entirely, but definitely. So we talked about programmable features. Unlike a normal exchange, and that's another difference between a normal, how a security trades in an exchange and how the security would trade as a digital security. Digital securities can be traded 24/7. You don't have to have a market opening, market closing, opening price, closing price, no. Because it's on a ledger. If the transaction has all the criteria to go through, the time of day doesn't matter. And that's another key feature in terms of a Japanese issuer wanting to access a Latin American market or vice versa. Because you can have the markets open. You will have that time of day where you can participate in that trade you choose to. Just because it's open 24 hours, it doesn't mean that it makes it more liquid or less liquid. It's like the currency markets. The forex markets are open 24 hours. It doesn't mean that there is constant stream of liquidity. No, there's bouts of liquidity. You have your Asian open, Asian close, which matches with European open, then vice versa on the across the Atlantic once the US opens, and then Europe closes, and then the West Coast opens. So, currency market liquidities are also like that. I believe it will be similar once you have 24/7 trading. Lower impact costs. Once the ability to disintermediate market participants, the end goal of that is that it reduces the cost to make a transfer or trade. Yeah, today within the exchange now, the brokerage income the brokerage fee is like, cascading to it's a race to the bottom, for a lack of a better word. When you have digital securities, even the role of a broker can be questioned. If it's only an execution-only broker, there is no room for this. You need to add value to the client. You need to tell the client what to buy or why he should buy or sell something. Or you should be able to bring market participants into a venue to buy or sell. There is no room for execution-only brokers in this space. There is no room for depositories. You don't need a depository because you have a distributed ledger which holds your registry, right? So you don't need a conventional custodian, right? Say, for example, you are a fund today, an equities fund or a bond fund or a real estate, whichever. Let's look at equities and debt. If you have a custodian, each trade you pay on the assets, total assets you manage under a custodian, you pay a percentage. Every time I sell a Omani security and buy a Kuwaiti security, on that FX I'm charged on the fund, right? That's what the custodians do now, right? You don't need that kind of stuff here. You would need a third party to probably hold your private keys to the security, or have like multi authorization points which allow before a security trade happens. But you can get rid of all these these parasital fees that exist within the current ecosystem. Transparency, because it's in a ledger, because it's in a public ledger which you can query, you can view, there's transparency. When a trade happens, you can see. For example, have anyone of you tried going into like blockchain.com and seeing the ledger of what the trades are happening, of how transfer is? Let's look at it like this. You make a fund transfer. Say you transfer Dubai, Shanghai, okay? You go to your bank, collect the accounts, enter it, press transfer. After you press transfer, you don't know what happens to your money, right? Like until it hits the other account, you're at the mercy of someone picking up answering when you call or replying when you mail and telling you whether it's going to be 24 hours, 36 hours, or whenever they choose to do the transfer. Right? Or the recipient gets the SMS to say the money has come. Whereas, if you transfer on the blockchain, maybe a Bitcoin, maybe another crypto, anything, you can see where it is. You can see from exactly where it went, from point A to point B. It's trackable, it's traceable, right? Real time. Same thing, you're using the same technology, so every single act that gets done on this as a digital security is there for you to see. So it brings that level of transparency to any trade. Immutability, multiple ledgers, everything has to be recorded the same way. So if one doesn't, the transaction doesn't get recorded. Key feature. So in a nutshell, the benefits, and from a transformation point of view, it's now what we have is what you call a centralized custodial model, and we are moving into a distributed ledger model. That's from an ecosystem transformation, and these are the intermediaries you can remove. There are many people who perform functions around some of these things which you can remove. Reduce cost, reduce impact cost, make it faster, make it smarter, possible. That's what this technology can do within the capital market. Let's look at key transactions, and this would give you some color into what the big players are thinking about it. I made an assumption here. I know all of us, most of us here would be investments or finance professionals, so we like to see big brands, what the established players are doing. So based on that assumption, I focused on getting examples for what the big guys have done, or some of the guys who are big. But really, the ones who are doing the cooler stuff are the names that you don't know of. So keep that in mind. By having said that, let's see what the World Bank has done. The World Bank established a lab sometime in 2017 to figure out exactly how this technology can be used by them, where all they can use it, whether be it giving identity to refugees to issuing bonds. That's what they did. They did it in Australia, and they did one issuance, then they paid coupons, they did a top-up issuance, or rather on-tap issuance, and then they I think they closed it also, or they let it mature and closed the bond. The only reason why they did this is for them to know for themselves how it works, or whether it will work for themselves, or whether it will work for them. And why would an institution like World Bank want to experiment with this technology? Because they seem to believe in its transformative ability, and more importantly, probably reduce cost in the issuance process. I don't know whether they managed to do it in this transaction, but definitely they will be able to do it down the line, because they figured out how things are done. So that's one thing in terms of credibility for the technology. This is another interesting transaction which happened. Yeah, on the swaps. Again, I wanted to bring in the names to show you who's involved and what they are doing. This Santander is a key investor within this space as well. They have invested into companies, startups in this ecosystem. Seems to be one of those entities which are quite progressive in terms of wanting to figure out how this technology works, and also more importantly to see how much can it come and eat into their bank's revenue lines probably. So it's probably an act of defense to figure out what they do so that they can be prepared or transition with them. So they did a bond issuance and called it back as well. So they did the full cycle transaction to have in-house knowledge about how that ecosystem would work. Bitbon, I work closely with them. Nice team, and this is something cool that they did, because and a fact that I want to emphasize here is the 87 countries from which they sourced investors. So Bitbond was a company established to provide loans to SMEs. Then they developed their own system. Today they are in a position to enable banks and issuers issue bonds on a blockchain. So that's the software or the architecture, the platform that they have built. But what I want to show is that they were the first BaFin approved bond issuance, that is the German securities regulator approved, and more importantly, their investors came from 87 countries. So a small player out of Germany utilizing the technology, sourcing capital from around the world. HSBC is, shifting assets. They're all in it. So for whatever reasons, they seem to see some merits. So if dropping these brands adds some value to it, that's one of it.
Question for you. You've gone through various benefits of the wholly digitized approach. What additional risks, if any, are associated with a wholly digitized approach through to a digital security compared to a partially digitized approach that one may be constituting right now?
Yeah, so say for example you've issued on a protocol. Say you've chosen the Stellar protocol, right? And you issued your digital security on it, or it was on Ethereum. Maybe you did a ERC20 or 1400, whichever protocol you've chosen to issue your digital security. Something goes wrong in that protocol, for whatever reason, then the network crashes. Yeah, you'll have a problem. It's the same thing as if the exchange crashes for that time. Can it be hacked? Yes, but what would you achieve with it? These are not bearer securities, right? In the cryptocurrency world, if I hack an exchange, if I hack a wallet, I walk away with something of value. I take the cryptocurrencies, be it the currencies or the tokens, I transfer into my my wallet or excess wallet. We walked away with value here because these are bearer securities or bearer assets. Okay, whoever who has it owns it, right? In a digital security, so what? You come and you hacked my wallet, my account, my exchange. It doesn't really make much of a difference. If it's entirely digital, then what will you do? You'll have to pollute the full thing. Then I don't want to say impossible, but yeah, you'll spend a lot of money trying to do it. Probably figure out before that. If it's partially, that is where the registry is held manual, but everything else is there, then you hack it, no point, because in the paper you're not the owner. So you will walk away with it. I will just cancel that security and I will issue new ones to the rightful owner. You would have wasted your time. So, but having said that, let me think if I've addressed all the risk. So we've addressed the tech side, the hacking. What else? What else are you worried about?
What you're saying is, well, I'm not saying worried about it, I'm just trying to understand
Yeah,
the other side of it.
of course.
But so from what you're saying, it's more so associated to the front end when you're actually creating the digital security. If anything, it's more so there once it's on, and it's on it's tradable. At that stage, the risk is mitigated, I guess. Because as you say,
Yeah, so this hacking part it's fine. That's not a problem. But when you're issuing it, yeah, so you need to be conscious about the smart contracts you write. So you need to have a code auditor and stuff to see if the smart contracts are valid or if it says the right thing. Say, for example, you issued a preference share which says that 5% coupon plus 20% of profit every year would be paid. Okay, so they'll say the guy who coded it says instead of writing 20%, wrote 80%, right? And you didn't check it. Yeah, you'll pay 80% out. So, pardon?
You mentioned if it crashes, everything goes.
Well, if as an organization here within the DFSA, we have we have continuity, like crisis planning, right? So if our systems crash, we have backup, we go off-site, we have different ways of managing that risk. Anything you do now to protect your PC, your server, your corporate information, your tax information, you can do the same thing. So if it crashes, we will wake up and then we will fix it and we will run again. And it's not end of the world.
It's not a blockchain.
Pardon?
It happens like say over normal crashes, but not on a blockchain where you cannot replace this.
No, yeah, so what does it mean then crashed? You mean a fork? Somebody forks the public chain. It doesn't really matter if they fork it, they've gone. That's the fork. It's gone. You're still on this part of the chain. You will continue to run. You will continue to build on this way. They've just forked and moved out on here. Right? So blockchains are, there are three different things, right? So you have a public chain, you will have a private chain, and then you will have a hybrid, a mixture of public and private. Okay? In a public chain, it's public, it's transparency, it's immutable, it's verified by multiple nodes. But you have this risk. Maybe there's a fork and all these things. In a private chain, it's like, it's more controlled environment. Of course, you can put a node with the regulator, a node with multiple brokers, node with key investors. So you can make the ecosystem acceptable to you. But yeah, there's no forking here. It's a private chain.
You were mentioning about how, for example, one of the benefits would be for someone who wants to invest in an entity that is in a complete unknown jurisdiction, knows nothing about it, but the system will give certain assurances of the safety of investing. Now, you will have to rely on the fact that the code has been done properly and that everything is, all these requirements that the security will expect investors to complete are properly done. Do you see, and the fact that this is not regulated, you won't know who coded that specific security. So do you think that there might be perhaps a need of maybe third parties to validate? Because for me, I don't know who wrote that code. Probably it's very clear what are the requirements, but I don't know who actually did it and if they did it correctly or not. Would you see that need of maybe a third party who will be able to validate that so that I can have certain assurance that that will happen, right?
Yeah, sure. Okay, one thing though, you mentioned that this is not regulated. What do you mean by this? What is the this?
We were talking about about the coding, for example.
Okay. If a code, if the smart contract within a digital security is not written right, it doesn't really matter whether it was a smart contract or whether it was no contract or whether it was a paper contract. If you do a trade and if you break the law, if you violate securities regulations, you have violated securities regulations. Full stop. There is not going to be any mercy that there was a code which was not written right. Number one. So, which means, comes back to your other thing, that is, every single transaction, for it to be valid, needs to be compliant. Because if it's not, a lot of people will get into trouble the same way it will happen now. Right? Where it's different is that there is some ways of reducing your compliance. It augments the compliance process. I.e., currently, if I want to trade a private security between country A and country B, I need to check country A's regulation, I need to check country B's regulation, and then I need to check from which jurisdiction this security was issued from. Okay, and if it's compatible to both and so forth, right? All of that have to be done in the same way, even in a digital security, because nothing has changed. It is still a share, it is still a bond. What the technology can do is that you might be able to write some of these rules in codes to reduce that compliance process, okay? But if you missed it, it's a violation. So do you have third parties validating it? Absolutely. So let me jump a few slides here. Look at this example, okay? Securrency is being built only for this. Okay, so they've been funded by Wisdom Tree. One of the investors was also Abu Dhabi Investment Office. They run on this, they're building on the Stellar protocol. And what they are doing is that they're writing these rules for transfer of securities. So Wisdom Tree is a large ETF operator, right? What they want to know is, can they use digital securities to reduce their cost? Can they reach a wider pool of investors? And they are using securrency to see if that can be made possible. Now, like securrency, there exist many issuance platforms. Say for example, Securitize is one of the issuance platforms. Last night, BitGo bought over Harbor. Harbor is an issuance platform. There's multiple shift markets, Bitbond, you can use it for your protocols. There's many guys who can do it. But the key thing to remember is that nothing changes from now our normal securities to this. Everything is the same. It's like, you go for an 8th grade math test, they don't let you use the calculator, but you go few notches higher and they let you use the calculator. But it's the same math you do. It's the same thing. It's just, something to make it faster. So let me go through the examples here, because this gives you a good, a nice color into what's happening in this industry and how the people, the key players are thinking. So if you see how a dinosaur is trying to maneuver itself and to prevent itself from getting extinct, it will give you an idea where the little guys are trying to nibble on. Right? So look at this. This one, the SIX exchange. So this is your normal Swiss main exchange is building a digital securities exchange parallelly. Gives you a color of what a main exchange operator is thinking. Look at this, Singapore exchange is not building on their own. Instead, they went and invested into 1X, which is a private securities exchange. Okay, and runs on chain. I mean, they update it to the Ethereum public chain. So that's two examples. The London Stock Exchange allowed an issuer to raise money by having their shares tokenized and their registry operated by a third party. These guys are looking to see what they can do with this technology, how it will impact. So these are the little guinea pigs that, who are sent in front. This is another a key development as well, where Vanguard looks at the currency side of things. Right, it's the same example that we go back to. That is, when you have a custodian, every time you do a transfer, the bank makes money on the FX, so does the custodian. Or if the bank and the custodian are usually the same, so you pay FX, you pay a trade fee, you pay on the AUM. Yeah, so these guys trying to see, okay, can I use technology and eliminate this part out and keep it for me? So they were focusing on the FX cost. The guys are moving 5.2 trillion. It's not chump change, right? So it makes sense for them to be worried about it. We looked at this example. Franklin Templeton is issuing, it's actually closed their US money market fund, and it was issued on a Stellar blockchain as well. So it's your normal conventional money market fund, but instead of issuing it as units, those units are now issued via Stellar. So the registry is the Stellar network. What are the challenges? Probably your risks are somewhere here as well. Regulatory complexity and lack of clarity. In many jurisdictions, the regulators have similar questions to what you, that kind of thing is there. It's like where they've not really separated what a digital security is, what does it mean to have a cryptocurrency, what does it mean to have a utility token on it, the difference of it, and have they clearly defined that? No, number one. Number two is that most regulators have taken a stance whereby they said, if it's a security, existing securities regulations apply. Go and comply with the existing securities regulations and you will be fine. Yeah, you can. But when your technology is transformative in some of the features, like the registry, where the proof of ownership is kept, right? Unless there is a legislative piece of unless there is change in legislation to accept that, this technology will be sub-optimized. Second one, secondary market liquidity or investor demand. There is lack of liquidity at the moment, but that's because you need time for people to come into this space. It's going to take time and stuff, but that's a challenge. I don't think for me, I don't see it as a threat to the industry, because I see the developments now are rails. Rails for growth are being laid. So it's a question about when the train would stop. To make sure that we all get back home in time for dinner, I'll make sure that you have a look at it. Ask me any questions if you have now. Or else let me quickly run through the last bit, which is key. If you look at the ecosystem, it's very similar to what we have now. Okay, there's nothing different because it's just a security, a technology has come in. So it's an evolution. An evolution in the thing. It's not like a revolution. So it's an evolutionary process. It's there to improve efficiency. It's there to add value to every single one of us. In terms of a journey of an issuer, just like in the current world, you would have to have professional players, services come in, help you out, which means this technology, even though it's currently being used by startups as a way to raise capital, they are not going to be the ones who benefit the most. It's going to be your mid-level companies. It is the companies which want global expansion. It's the companies who want to have a diversified shareholder base. It is for the entities who have a track record, a profitability, where you can go from one jurisdiction to another jurisdiction and say, hey, I am doing something good here, and you will have enough evidence to believe in it. That's when global investor pool becomes accessible to you, and that's when doing a digital securities offering makes sense. So to in close, how I see the end goal of this transformation should be is that all securities should be issued will be at some point issued on a ledger. The protocol, the underlying protocol will not really matter. Instead, you would have your wallet, or your custodian will hold it for you. You can go from one exchange or to a marketplace or to an ATS. You would be able to just log in, go in there. You would automatically get KYC'd because your digital identity will help you to do that, and everything will be there. You will go from, say, you feel like trading in NASDAQ for half an hour, yeah, you would trade your stocks or your bonds, whatever, anything of value there. Half an hour later, you feel like, oh, let me change. Let me go trade in Lima now. You would be able to move all your assets, go into Lima, in any marketplace there, and start trading just like that. And all of these transactions, your ease of movement would be recorded on a ledger, and all these multiple layers of, be it compliance, be it settlement, be it operations, that's the end game. And that's where we should, I believe that we will at some point get.
So it will increase the unemployment rate in the economy.
No, it won't, because so when we had the mines, right, we had many hundreds of people working to take a kilo of gold out, okay? Today, you use machines and take 100 kilos out, but you probably use one compared to the 100 you used before, right? But yes, if they only wanted to mine gold, they would be unemployed. But if they wanted to build a machine to mine gold, or to do activated carbon to refine the gold, or to design a jewelry that you can make with gold, they won't be unemployed, they would be elevated. That's what we should do. You cannot prevent progress of technology, of evolution. It's gonna come. It's how you prepare for it. On the pit trading, you needed 200 brokers to do 100 millions of trades, right? Today, all you need is a fixed protocol line and a nice, fast internet connection to do 1 billion of trade, and one person can do it.
What's the mandate of GRIP? What do you guys do at GRIP?
In the best interest of professional decorum, I don't think this is the place for me to talk about my employer, but I'm very happy to speak about GRIP outside. I'm sorry about it, but I'm very happy to speak about it outside.
Can we say that STOs are the future of securitization?
No. Securitization means I have a lease, okay? I need to receive 10 payments. I take those 10 receivable payments, I put it into an SPV, and then I sell that receivables to you. Right? True sale happens here. I remove it from this borrower's balance sheet given now. That is securitization. Okay? This is not securitization. This is digitization of the entire life cycle of the trade thing. This used to be called security token when it initially came, right? But because of all the mess that the ICO markets did, it was not from a branding point of view or people's psyche point of view, using the word token was detrimental. So they changed the word digital security. Now you use digital security and the first thing people ask is, oh, so what? I'm not trading digitally now? So that's why I wanted to clear the air initially, but the whole thing about is that is the entire trade cycle needs to be digitized. This technology enables you to digitize the last one, which is the registry, and real-time update within that registry.
What is the possibility of different exchanges coming into a single private blockchain?
No, so interoperability. You don't need a single private thing. So the idea should be that irrespective of which protocol I'm on, right, I should be able to come into your walled garden. If it's a private exchange, it's a walled garden, and there you will be able to speak to me. And you can take my security there. So it could be an API integration, it could be any number of things, but whatever it is, it's interoperability. And seamless interoperability probably is the next thing. I think there's a lot of people building this, like, I can't remember the name, but these are guys, the stacking guys, right? Okay, I think if you read about BitGo's acquisition of Harbor last night, which was announced, would be very interesting, because the first thing BitGo did is that they bought a stacking services provider, right? A tech guy who specializes on stacking. So which means before they bought Harbor, they bought someone who can give them the technology to know how to integrate. And this can be a blowout within the digital security space, because BitGo already deals with institutional investors to custody crypto assets. Right, close to 4+ billion in terms of custody they have, number 1 or 2 competing, and they've gone and bought a issuance platform which addresses all the compliance, the codes, everything. In combination, you have a power. You have something good here now.
So what is stablecoin and which cryptocurrencies can you use to trade digital securities?
Okay, stablecoins are tokenized representation. Which is backed by another asset. Be like, say, for example, $1 is represented as one token on a chain, right? Or it can be $1, it can be 1 dirham, it could be an ounce of gold. Doesn't matter. Or rather, the price of an ounce of gold, which gets linked. That's a stable coin. It's just a tokenized representation that exists on a blockchain. And you can use it as a medium of exchange or transfer of value. Your other question was, what can you trade?
Which cryptocurrencies can you use to trade digital security?
It's two different things. Like, I mean, you can use any cryptocurrency theoretically to buy a security, but you're going into two different ecosystems here, okay? Within the securities ecosystem, and actually, thank you for asking this. This is quite an interesting thing. In the securities infrastructure, compliance matters, okay? In the cryptocurrency, compliance and tracking back is only coming now. So for example, if you take chain analysis as a software, they can look at a currency's transaction and track back maybe 100,000 steps to see how each coin had moved, okay? But if you buy a security with a cryptocurrency, you would give a migraine to a compliance officer, right? Because there's many things that needs to get reconciled there. One is they will have to figure out how this cash came, so that needs to be integrated with someone like chain analysis who can validate and say that this currency is clean, this was not used in any nefarious activities, the same way you would do now for cash. Cash is anonymous, cryptocurrencies are pseudo-anonymous. So cash is more deadlier than crypto. But anyway, so you'll have to do that. So to use cryptocurrency to buy a digital security, possible, very possible. But yeah, you'll have to jump the hurdles. I know I've taken my time. Thank you very much. Good night. Thanks.